Let's dive right into this explainer and cut through all the static of modern finance. Our goal today is pretty simple. We're going to build a professional, actionable framework for your wealth. We're living in this really fascinating time where the barriers to entry for investing have practically vanished. But unfortunately, the barriers to losing your life savings, those vanished right along with them. We're in an environment of extreme access right now. And without the right principles, well, that access can become incredibly costly.
So think about it. From TikTokers aggressively pushing copy trading to brand new AI tools and prediction markets popping up everywhere, we are essentially navigating a minefield. It has literally never been easier to lose money fast. The access is incredible for sure, but access without a framework? Honestly, that's just gambling. The internet has heavily gamified finance, turning what used to be a very careful long-term business strategy into a high-speed slot machine right in the palm of your hand.
And there's this massive gap between the flashy promises of social media and the grounded reality of professional investing. The promise you see pushed everywhere is that some algorithm or an influencer can give you an insider edge to instant wealth. But the reality? Far less glamorous. You're mostly dealing with hallucinating AI, highly illiquid private assets, and platforms that are structurally designed to extract fees rather than actually build your wealth.
Here's our agenda for today. 1. The modern investing minefield. 2. AI as your financial advisor. 3. The social media hype trap. 4. Hidden risks in complex markets. And 5. The smart investor's playbook.
Part 1. The modern investing minefield. A golden age of risk.
Moving right along to Part 2, AI as your financial advisor. Help or hazard?
Okay, so while we have more access to financial tools than ever before, jumping into them without a solid foundation is basically a recipe for disaster. Take artificial intelligence, for example. Platforms like ChatGPT are actually currently piloting access to your actual bank accounts to give you tailored financial insights. OpenAI is actively testing a finance-focused window where you can plug in all your data for budgeting and portfolio guidance. And on the surface, the pros sound amazing, right? You get 24/7 accessibility and it's highly cost-effective. But here's the catch. Relying entirely on an AI for your finances is exactly like Googling medical symptoms before seeing a doctor. It's a great baseline, but highly risky for an actual diagnosis. AI models suffer from hallucinations. They sometimes just confidently make things up out of thin air. And if your AI miscalculates a compound interest formula, well, the financial consequences fall entirely on your shoulders.
Which brings us to a really critical concept, fiduciary duty. AI developers are not registered advisors, meaning they completely lack the duty of care required to protect you from inappropriate products. Even if an AI throws up a disclaimer stating it isn't offering formal financial advice, that doesn't magically shield your portfolio from the real-world impact of a bad recommendation. A registered fiduciary is legally bound to put your financial interests above all else. An AI, it's just a language prediction model guessing the next most logical word in a sentence.
All right, Part 3. The social media hype trap, influencers and prediction markets.
We've all seen the viral videos, haven't we? Some influencer sitting in a fluffy housecoat claiming they turned $2,000 into over $100,000 just by buying tech stocks. Or day traders urgently pushing you to join their exclusive prediction market Discord. These platforms let you bet on literally anything, from political elections to global conflicts. But let's look at the heavy reality check here. Independent blockchain analysis shows 84% of polymarket prediction users actually realize losses. Yep, 84%. These platforms are aggressively marketed as a way for you to profit off your unique worldview, but the underlying data reveals a brutally different story.
When we actually look at the median ROI by user type, prediction markets are functionally just a casino, with a negative 8% return for retail users. The everyday individual is absolutely losing out to the house and to high-speed algorithms. Only the massive whales, the ones trading over $500,000, are squeezing out a meager, positive return of around 2.6%. So for the everyday investor, these are negative-sum games that are actively draining your wealth through fees and structurally poor odds. So before you take advice from a viral video or some prop trading firm, you should really apply this 3-point framework from the CFA Institute to evaluate the source. First, what's their motivation? Are they getting a fat referral fee for signing you up? Second, is their advice consistent with proven, boring, reliable market data? And finally, what are their actual qualifications to be telling you how to manage your life savings?
Which brings us to Part 4, Hidden Risks in Complex Markets, the Illiquidity Illusion.
Let's step away from the retail hype for a second and look at complex alternative markets, like private credit.
Because it's not just your phone trying to trick you. Institutional-grade products are increasingly being pushed to retail investors, and they come with massive hidden risks. Private credit is currently booming to fill gaps left by traditional banks, but when corporate borrowers default, which is happening way more frequently as interest rates bite, these funds gate or freeze withdrawals. Think of it like a crowded theater where someone yells fire. The fund literally locks the doors so everyone can't rush the exit at once to prevent a fire sale of assets. The result? Your money gets completely trapped exactly when things are going south.
And we see a really similar structure in sovereign wealth and infrastructure initiatives. For example, Canada's new $25 billion Strong Fund plans to let retail investors buy into national infrastructure. Now, while exclusive access sounds super appealing, it definitely doesn't eliminate decade-long liquidity risks. Infrastructure projects like building toll roads or energy grids are not like publicly traded stocks that you can just sell on an app in 3 seconds. They take well over a decade to develop and actually turn a profit. You might be supporting the broader economy, sure, but you have to be fully prepared to have your capital locked away for years.
A disciplined investor must also remain totally impartial to macroeconomic headlines, whether that's reading about debates around Alberta independence or the evolving tariff structures between Canada and China. Making sudden, panicked moves based on political news rarely beats the broader market. It is crucial to remember that by the time you're reading a dramatic headline, the institutional market has likely already priced that information into the assets.
Finally, Part 5, the Smart Investor's Playbook for Sustainable Wealth.
So how do we actually navigate all this chaos? Well, let's look at a really simple, step-by-step playbook for safe and sustainable wealth building. Think of this as your professional antidote to the algorithms. Step 1. Keep a cash buffer for emergencies. You need 3 to 6 months of living expenses safely set aside so you are never forced to sell your investments at a loss. Step 2. Consistently buy diverse, cash-producing assets like broad market index funds. And step 3, strictly verify any financial advice you receive using that CFA framework we just talked about. Instead of chasing some crazy 10x return on a gamified app, deploy your capital thoughtfully. Treating your money like a casino only benefits the house. You need to treat your portfolio like a serious long-term business. And a business requires steady operations, a clear strategy, and most importantly, professional consultation when you're dealing with complex, tailored needs. Because sustainable wealth is built by owning a diverse range of high-quality assets that compound quietly over decades. It's not flashy, it definitely doesn't make for a viral TikTok, and it certainly isn't an overnight prediction market win. As one viral video actually managed to get right, the rich don't get wealthy by saving, they get wealthy by owning. It's about consistent ownership and letting time do the heavy lifting. Just that quiet, unstoppable force of compound interest working in the background year after year. So, I'll leave you with this provocative thought to consider today. In an era of endless financial stimulation, are you going to let the algorithms and influencers gamble your future, or will you step up and take control of your wealth? Start today by assessing your emergency fund and being strictly intentional about who you listen to. Thanks so much for joining me on this explainer.